Good morning, everyone. Thank you for joining us for today's webinar, What is Life After Coronavirus? Coping with Financial Anxiety and Recession Readiness, presented by Rea Associates, a top 100 regional CPA and business consulting firm with offices across Ohio. My name is Imani Fields, and I'll be moderating today's presentation. Before we get started, there are a few housekeeping items to cover. First, if you have any questions during today's presentation, you may enter them into the chat box onto your screen. We will try to answer as many questions as we can at the conclusion of today's presentation. However, to be respectful of your time, we will conclude today's webinar at noon. In doing so, we know that there's a chance some questions will remain unanswered. Following today's webinar, we will review the unanswered questions and send out the answers via email as soon as we can. When you receive this email, you will also receive the recording of today's presentation as well as a link to participate in a very short evaluation. Please take a few minutes to share your thoughts about the presentation as a whole, the information provided, and our presenters. Your feedback is important as we determine future webinar topics related to the COVID-19 crisis. Also, if you would like a copy of today's slides, you will find that they're available in the handout section of the webinar dashboard on your computer screen. Today's presentation will be given by Paul McEwan and Doug Bambeck. Paul is a principal at Rea Associates, where he leads the firm's retirement plan consulting and administration services team. He is responsible for consulting with clients on fiduciary best practices related to their qualified retirement plans. Doug is a president, chief compliance officer, principal, and a financial advisor with Investment Partners. With more than 20 years of financial services experience, Doug is committed to helping clients control the fiduciary liability that comes with running a qualified retirement plan. Securities and advisory services offered through Commonwealth Financial Network member, FINRA SIPC, a registered investment advisor. Investment Partners is a registered investment advisor. Additional advisory services offered by Investment Partners are separate and unrelated to Commonwealth. Fixed insurance products and services offered through Investment Partners or CES Insurance Agency. Today, Paul and Doug will discuss the financial anxiety, recession worries, and more that have stemmed from the economic uncertainty that has accompanied the COVID-19 crisis. Doug will begin by talking about how to address the financial stress that stems from today's economic uncertainty, and Paul will wrap it up by talking about the overall impact COVID-19 has on 401k plans. We will wrap up today's presentation with a substantial question and answer session. And now I'll pass it on to Doug.
Good morning. Thank you for those long list of disclosures. I hope everyone's having a great morning. I'm sure most of you have been watching the news and trying to digest who or what to believe. There is definitely no shortage of opinions out there, but I want to remind you that nobody has a crystal ball and they cannot predict the actual outcome. In the years to come, you will find out that hindsight is 20/20. That is why I want to concentrate on historical data and reassure everyone we will get through this and we will thrive. Will that be in 6 weeks or 6 months? Nobody knows the answer to that question. A big portion of the unknown is when we will be able to get America back to work. We should have more insight to that question over the next 2 weeks. It is important to remember we had a robust economy going into this crisis. How fast we get back to that level is unknown, but the federal and state governments are doing everything in their power to pass aid packages to help speed up the process. It is important to note that most Americans are in a much better financial situation than in previous downturns. In the fourth quarter of 2007, households averaged 13.2% of debt payments versus their disposable personal income. Compare that to the fourth quarter of 2019, and that debt service was down to 9.7% compared to their personal income. The disposable personal income, I'm sorry. Also, household net worths in 2007 were just over $71,000 compared to $118,000 in 2019. This is why it is more important than ever to take a deep breath and relax. A question that I'm getting asked every day is the market overreacting to the coronavirus crisis? The market has pulled back significantly in the past couple of weeks. In fact, we are seeing volatility like we have never seen before. Of course, concerns are mounting, But at the same time, we must ask ourselves, what's behind such volatility? Let's take a step back and assess what's really going on. The damage is real. It exists now and is getting worse every day. Most of you saw the headlines this morning of the unemployment rate rising sharply. That should not be a surprise to anyone. When you shut a country down and shut restaurants and businesses down, they're doing everything they can to try to help employees have cash so they can continue to survive. And unemployment is the main way we do that in the U.S. But much of the current discussion is focused more on the possible downside than the most likely outcome. That is, it has been focused on what could happen rather than what likely will happen. So let's take some time to think through what is likely to happen with the economy. I don't want to ignore the could happen. It's important to understand the downside risk, but we also will not assume the end of the world is coming. There are only two things that matter for stock prices: earnings and valuations. So any discussion of the collapse in prices has to center around what changed in one or both of these factors. Initially, the discussion has to be about valuations, as actual earnings have not changed yet, but we know they will. Let's start there. Over time, valuations depend on interest rates and the expected growth of earnings. With interest rates at all-time lows, the drop in valuations can't be about higher interest rates, as the lower rates would mathematically push valuations higher. The drop, therefore, has to be about expected earnings growth. With the market decline of more than 25%, markets are telling us over time, earnings are expected to drop by about 25% or more. That assumption might seem reasonable in the short term, but stock prices typically discount the next 10 years or so of earnings. So that expected drop is not in the short term, but over the next decade. When we think about what the market is likely to do next, we have to ask the question whether that assumption is reasonable. When I look at that question and say, is it reasonable? In the short term, absolutely. In the long term, it looks much less likely. When I look at the S&P 500, the average forward price to earnings ratio over the last 25 years is 16.3. When the market hit the peak in February, that price to earnings ratio was 19. As of yesterday, the price to earnings was at around 14.57. In my opinion, this supports the short-term impact to earnings, but not the long-term aspect. The long-term aspect makes the current valuation look cheap. Large sectors of the market are companies that simply are not going to drop that much. We've seen a run on toilet paper. Are people going to buy 25% less toilet paper once they use up the stockpile they've amassed? Will they buy 25% less food? Even for luxury items, will they buy 25% less iPhones? Will sales overall drop by 1/4 over the next 10 years? Doubtful. I don't think they will. There will certainly be a short-term hit, but earnings will recover over time. In the long term, earnings growth depends on population growth and wage growth. Population growth will continue. Wage growth is healthy, and although it'll take a hit in the short term, it will come back in the long term. We're in a very good place economically, and any declines will be from a strong place. So from an earnings perspective, short-term damage is certain, but over the medium to long term, the fundamentals remain fairly supportive. Until we get more facts, volatility will continue. I know it isn't easy, but resist the urge to sell. Even though your portfolio may have lost some value over the past few weeks, it pays to stick to your plan. This data has not been updated with the most recent movements, but it's important to note. Over the last 20 years, 24 of the worst 25 trading days were within 1 month of the 25 best trading days. If you took a hypothetical $100,000 investment 20 years ago in the stock market and did nothing with it, you would have over $324,000. If you missed the 10 best days over that 20-year period, you would only have a little over $161,000. If you missed the 25 best days over that 20-year period, you would have actually lost money from that $100,000 and you would be just over $82,000. So it's very important to not try and time the market and just stay the course. When you try and time the market or make an emotional decision to change your allocation, odds are you would have been better off leaving it alone. If I look back at my personal 401k, the best investment I ever made was in March of 2009. That was the low point of the 2008 crisis. In March of 2009, things looked like they could only get worse, and the news reminded you of that every day. With hindsight, we can see that wasn't the case. It was actually the best time to buy. History shows the market lows occur when fear is at its worst, not after things start to look better. You need to keep in mind the heavy cost of market timing. Dalbar did a famous study titled Quantitative Analysis of Investor Behavior, and they looked at the 20 years prior to December 31st, 2018. During this period, the average investor achieved a scant 2.6% annualized return. Compare that to over a 6% annualized return of a 60-40 stock-to-bond portfolio. Thanks in part to badly timed and often emotionally driven investment decisions. With that in mind, the best thing you can do during these times is stay healthy. Try to control your anxiety. I know that is easier said than done, but I have never seen this many people with anxiety levels this high. Even when I go for a walk with my kids, it seems like everyone is on edge. It is important to keep things in perspective and remind yourself, we will get through this. We always do. Anxiety of any sort can have a negative effect on your health. In the short term, it can cause irritability, headaches, muscle tension, fatigue, and many other symptoms. Longer-term chronic stress can lead to more serious afflictions like high blood pressure, heart disease, and diabetes, the very things we're trying to avoid at this point. The markets and economy are certainly not worth risking your health, so it's important to take care of yourself during this stressful period. Try getting outside for some fresh air, taking a daily walk, riding a bike, and even eating healthy foods. You can also try relaxation techniques like meditation or yoga. I know with social distancing, you can't go to your yoga parlor, but there's plenty of YouTube videos and other things that you can do at home to do that. Get plenty of sleep. It's very important. If the evening news is causing you alarm and keeping you up at night, consider reading an enjoyable book. If you find yourself constantly scrolling through social media on your phone or glued to the TV screen, there is no doubt you will be inundated with stories of gloom and doom. Some media outlets tend to sensationalize stories to attract a larger audience. This can cause unnecessary alarm. If you feel you must check the headlines, try visiting the websites of more trusted sources. They will have the most up-to-date news along with tips on how to protect yourself. It's also good to find positive distractions like watching an upbeat movie, listening to your favorite music, or talking with families and friends. With technology, we can still interact while social distancing. And in Ohio, I know it's going to be a gorgeous day today. It's a perfect day just to get out and try to relax for a few hours. With that said, I would like to introduce Paul McEwan. He's got some very interesting takes on the changes that may or may not happen to your 401k plans. Paul?
Thanks, Doug. Good morning, everybody. It's a pleasure to be here. I wish the topic were a more uplifting and more positive one. I'm going to be speaking for about 20 or 25 minutes this morning. I've got a similar number of slides to go through. So I'm just going to get started, and we're going to have a Q&A session at the conclusion of my prepared remarks and the slides that I've prepared for today. So I just want to quickly put in context what I'll be discussing today related to your 401k plan. I'll be identifying issues that you may or may not have considered in light of the current healthcare crisis and its impact on your employees. No doubt you're getting lots of questions from your employees already and trying to formulate your business strategy going forward. Some businesses are further along in this process than others because they have been immediately impacted. That said, my comments are meant to be a high-level overview to help you identify issues and maintain operational compliance with your plan. If you have any questions regarding your 401k plan that is not covered here, feel free to ask your question during the Q&A period today, or follow up with me and I'll be happy to respond directly to you. I also recommend that you follow up directly with your TPA or your plan investment advisor if you have any questions after our discussion. Our topics for discussion fall into two broad categories today: plan impacts related to employees in transition, first becoming inactive and then hopefully becoming active employees again before the end of the year. There are certain traps for the unwary that you need to be aware of so that you do not unintentionally create compliance issues for the plan. Here, it's really important that you read your plan document, and I'm going to say that several times throughout the slides. As part of this discussion, I also want to make you aware of the tax implications of certain transactions that may be impacting your employees. And the second broad category is cost containment ideas related to your retirement plan. Here, the focus is going to be on discontinuing or delaying employer contributions until your cash flow returns to normal levels, and the impact of those employer contribution decisions. And secondly, whether the plan is allowed to pay certain plan-related fees like TPA and plan audit fees. And with plan audit fees, I'm assuming your plan has more than 100 participants and it's audited by a CPA firm. Some of you out there may have smaller plans that don't have an audit. You can be grateful for that. We will finish up with a few comments on recent legislative changes that Congress made. Actually, Senate passed it last night. I think Doug might have referenced that this morning. It goes over to the House now, the CARES Act, that were made, and that contains certain changes to retirement plans, particularly as it relates to hardships and loan provisions. So let's go ahead and get started. Next slide, please. All right, no doubt many of you today have already had to lay off or furlough some or all of your employees. Having been through that process myself in the past, I understand how difficult a decision that is. It seems like 2008 and 2009 is still pretty fresh in my memory. Those of you that have not had to do that yet, in terms of layoffs, may be considering it soon. Most of you probably know how to handle a normal termination of an employee and the process of distributing any vested plan balance. However, in the case of the current COVID-19 crisis, are your laid off or furloughed employees considered terminated and eligible for distribution from the plan? That might be something you're wondering about. For what it's worth, there is no practical distinction for 401k plan purposes between a layoff or a furlough. So I'm going to be using those terms interchangeably. Furlough has a connotation that the employee is expected to be rehired, as in the case of seasonal employees. But assuming the employee is no longer being paid and is eligible for unemployment benefits, they have met the definition of distribution for plan purposes, and they're eligible for a distribution. I've also heard of some companies continuing to offer health insurance benefits to terminated employees through some future point in time, but this is really of no significance from a 401k plan perspective. The health insurance benefits are going to be considered part of a severance package from a legal perspective. Of course, the reverse of this is also true, meaning if you are taking the approach of reducing everyone's hours so that you can continue to keep paying everyone something during this economic slowdown, then none of your employees have actually terminated and none are eligible for a distribution from the 401k plan. The important point is whether the employee is still being paid. It is not relevant from a plan distribution perspective whether you intend to rehire them when the crisis is past. Next slide, please. All right, so on this slide, I just want you to be aware that you may trigger with your layoffs what is known as a partial plan termination. So you're not officially terminating the plan. It's a term of art in the Internal Revenue Code called a partial plan termination if you furlough more than 20% of your active employees all at once. The only substantive result of triggering this rule is that any employees included in the reduction of force become 100% vested in all plan sources. Immediate vesting does not apply to any remaining active employees. This is important to know in case any of the furloughed employees request a distribution from the plan. They are entitled to receive 100% of their plan account balance. Next slide, please. All right, on this slide, I just summarized the negative impacts of taking an early distribution from a retirement plan. The unfortunate part of the current economic crisis, as Doug spoke so eloquently about previously, is the unknown duration. That single fact may cause many laid-off employees to request a distribution from the plan, particularly if they don't have much in savings. It's important to know these negative outcomes so that you can help your employees make good decisions regarding their account balance. When an employee is eligible for a distribution and decides to go ahead and request it, she's making a decision to liquidate investments that have likely just appreciated by 20 or 30%. In addition, assuming they are younger than 59 and a half, they'll be subject to a 10% excise tax on the amount distributed, as well as regular federal and state income tax. The biggest negative outcome is the fact that they will lose all future compounded earnings that their account balance would have earned prior to their retirement. And they'll be starting all over saving for retirement. Except now they're older than they were the last time they started, and obviously that much closer to retirement. Next screen, please. Many of you attending today may have plans that allow participant loans. If your plan loan program allows for suspension of loan payments for up to 12 months when employees are temporarily laid off, then they will avoid defaulting on their loan, assuming, of course, they come back before that time period. Loan defaults result in deemed distributions, which then trigger the same 10% excise tax and income tax results as early distributions that I just discussed. If your plan does not allow for a suspension of the loan payments, you should update it quickly. It's possible that if employees are not laid off for more than 90 days, even without a suspension policy, they may still avoid defaulting on their loan. A loan does not default until the last day of the quarter following the quarter that the last payment was received. So that's a little confusing. So here's an example. If an employee is laid off March 15th and makes a loan payment during the last payroll of March, then their plan loan will not be considered in default until June 30th. If loan default is avoided, then the rehired employee can begin making loan payments upon return and has the option of paying the missed loan payments immediately, or the plan record keeper can re-amortize the loan over the remaining time period allowed, but that time period cannot exceed 60 months from the original date of the loan. Next slide, please. So here I just want to address loan payments of active employees. I've gotten some questions from clients because they've gotten questions from active employees that haven't been laid off yet, that are making loan payments, and they want to know if they can stop. So as for your employees to continue as active employees, they must continue to make their loan payments via payroll deduction. They're not allowed to choose to default on the loan payment. This is because the plan sponsor, as a plan fiduciary, is required to safeguard all plan assets for the benefit of the employees, and the plan loans are plan assets. So your active employees may choose to stop making salary deferral contributions to the plan at any time, but they cannot stop making their plan loan payments. And I'm going to reference the CARES Act here because we're going to talk about it at the end of my slides, but there may be relief coming for employees. Hasn't been signed by the president yet, but there may be relief coming for employees currently making loan payments via the CARES Act that's currently being discussed in Congress. And again, it was passed by the Senate late last night, and it's over to the House now. So more on that later. Next slide, please. All right, hardship distributions. These must be allowed by your plan document. Not all 401k plans allow hardship distributions. When hardship distributions are allowed, they are typically limited to just employee deferrals. They cannot be made from employer contributions. Record keepers are generally pretty good at making sure funds are distributed from the appropriate sources. Check your plan document to see what it allows. Again, check your plan document. If your document does allow for hardship distributions, the plan participant must be under a heavy immediate financial need. There are a limited number of reasons that are considered safe harbor reasons for a hardship that are included in most plan documents. so that the plan sponsor doesn't have to make a difficult decision determining whether the plan participant meets the heavy and immediate financial need criteria. I've listed the most common safe harbor reasons on this slide. Note that Ohio has not been declared a federal disaster area yet. New York, Washington, and California have. Other states may have at this point, but as of a couple days ago, that was the list. And a preview of coming attractions, the CARES Act that is currently being discussed in Congress would make considerable changes to the hardship provisions I just talked about. So we'll talk about that in a little bit. Next slide, please. All right, this slide just summarizes the negative financial outcomes related to a hardship distribution. It's pretty much the same as an early distribution from the plan related to terminations. Also note that hardship distributions can't be repaid to the plan, unlike a loan. Next slide, please. All right, definition of compensation. Plan compensation is an area that frequently results in operational compliance errors for retirement plans. For some reason, and I don't know why it does not occur to many plan sponsors to check their documents' definition of plan compensation before making decisions that impact plan contributions. Most plan documents have a very simple, intentional definition of compensation as W-2 wages. And frankly, in my opinion, the simpler you keep your definition of compensation, the better. That means that if the compensation being paid is included on the W-2, it needs to be included for purposes of making contributions, whether that be salary deferrals or employer contributions. So if you're going to be paying your employees a special type of compensation related to the current crisis, you might be thinking, well, I'm going to do something different with that. I'm not going to withhold 401k. So I've listed some possible alternative types of compensation. Maybe there was some recent legislation that allows for federal paid sick leave or federal paid child care leave. Anyway, you might be thinking of some special types of compensation that your employees don't normally receive. Just make sure that your employees complete a special salary deferral election form before you don't withhold the salary deferral from that or calculate a match on that compensation, or discuss with your TPA the possibility of amending your definition of compensation in the document. However, great care should be given before excluding any type of compensation from the definition of plan compensation. That's a pretty complicated topic. You should talk with your plan experts. And again, my preference is to keep the definition of compensation as simple as possible to avoid operational errors. Next slide, please. Many of your employees may want to make salary deferral changes because they're concerned about having enough current income during this crisis. Just be sure to follow your plan documents rules related to how frequently employees can change their salary deferral elections. Many documents restrict employees to semi-annual or quarterly changes. Regardless of your plan's terms, though, employees are always allowed to stop contributing to the plan at any time. But then, of course, they're going to have to wait to restart their deferral until the next plan entry date. Next slide, please. Employee service crediting concerns. 2020 is shaping up to be a year that when you may have many employees with unusual hours of service. Be aware that most plan documents are designed to require a certain level of service to trigger eligibility, vesting, or the right to share in an allocation of discretionary profit sharing contributions. Make sure you're tracking these hours and properly reporting them year end so that your plan is operated in compliance with its terms, such as employee vesting that's properly updated. Next slide, please. Okay, this is going to be the last slide related to possible employee transition issues. We previously discussed how to determine when an employee has officially terminated for purposes of the plan and becomes eligible for a plan distribution. Now we need to consider what happens when that employee returns to employment at your company. These are known as the break in service rules. In order for your employees to have a break in service, they must be separated from service for 5 consecutive one-year breaks. That's a long time. A break in service would require that they meet the plan eligibility requirements before re-entering the plan. Since your employees most likely will not have a break in service longer than even a year, hopefully, they will return immediately to participation in the plan as if they never left. And then I just want you to note that if your plan has an auto enroll feature, again, you need to check your plan document to see what deferral percentage your employees should come back into the plan if they make no affirmative election when they come back in. There's some different options that you have there, and you need to check your document. Next slide, please. All right. Stopping safe harbor contributions. So we're going to be shifting gears a little bit here. We're going to focus now on changes that you can make to your plan design in operation that will make it less expensive for the company to continue to offer the plan. Of course, the first thing we all ask is, can the company stop making the match contribution if necessary? And the answer is most likely yes, but the action steps may be different depending on your current plan design. Plans with safe harbor contribution requirements will require additional steps compared to non-safe harbor plans. So let's walk through the safe harbor plan requirements first. There are two possible conditions that must be met in order for you to suspend your safe harbor contributions. Either one will suffice. You do not need to meet both requirements. So either the company must be operating at a loss for the year, or your annual safe harbor notice must contain conditional language that the plan may be amended mid-year to remove the safe harbor contribution. Fortunately, starting in 2014, most plan providers automatically started adding this language to the annual safe harbor notices generated for their clients. I know we did at Rea, and I suspect that other TPAs and document providers did as well. But please double check your annual notice document to make sure that this language is there. We'll look at some sample language that I pulled from the Rea Associates safe harbor notice on the next slide. Note that these same conditions and requirements apply regardless of whether your plan uses a safe harbor match or the alternative 3% non-elective contribution. So next slide, please. All right, so here is the sample language I talked about. This was copied directly from the Rea Associates Safe Harbor Plan notice for 2020. Please note the language highlighted in red. If your notice has this language, then you can, or something very similar, then you can amend your plan to eliminate the safe harbor contribution. Now, let's talk about the process of how you would do that mechanically. Next slide, please. All right, so first you're going to need to let your employees know that you intend to change the plan to eliminate the safe harbor. And they have to be given the opportunity to change their deferral election. Your plan service provider can provide you with a notice that meets IRS requirements. So don't try to write it yourself. You'll have to make the safe harbor contributions through the effective date of the change. But once this is done, your plan reverts to being a traditional 401k plan subject to non-discrimination testing, and the so-called ADP ACP tests must be run on the entire plan year. This will likely result in test failures and required corrective contributions for owners and possibly other highly compensated employees in the first quarter of next year, but presumably that's the least of our worries at this point. The last couple of points are equally important. You must amend your plan document to eliminate the safe harbor contribution provision, and be aware that without the safe harbor contributions, the plan may be required to make top-heavy contributions. Plan is top-heavy. A lot of people get top-heavy and non-discrimination confused, but a plan is top-heavy if more than 60% of the plan assets at the end of the previous year are held in accounts of key employees. Your TPA or record keeper should be able to tell you if your plan is top-heavy based on prior year compliance testing. And the top-heavy requirement is a non-elective contribution equal to the highest contribution percentage of the key employee group. So, and that's including their salary deferral contributions. So it's entirely likely that if your plan is top-heavy, you'll have to make this top-heavy contribution. That's one of the benefits of a safe harbor plan. It knocks out the top-heavy contribution requirement. The top-heavy contribution requirement, the maximum contribution that you would have to make is 3% of compensation for employees if any of the key employees were contributing at least 3%. So pay attention to top-heavy and check Most plans are not top heavy. The bigger the plan, the less likely it is that you probably are top heavy. But for sure, you need to check with your TPA on that question. Next slide, please. Okay, so that was a lot of information on safe harbor plans. Things are a little simpler in the non-safe harbor world. For those companies with non-safe harbor match provisions, the first question is whether it's discretionary or whether it's actually written into the terms of your plan document. We advise most of our clients to keep things as flexible as possible and leave the match requirement as discretionary, but that may not be your situation. But if it is, you can change the match formula or eliminate it on the fly without a plan amendment. It is obviously recommended that you communicate any changes in the match to your employee group so that they're not left to discover it on their own. There is no requirement that you notify employees in this circumstance. If your match formula is not discretionary, you will need to amend your plan document prospectively and provide employees with a summary of the changes. So again, please check your document or check with your plan service provider. Next slide, please. Now that we've covered how to eliminate the employer contribution, I just want to mention that a good alternative, and much simpler, frankly, may be to adopt a wait-and-see approach, since we have no idea how long the current economic crisis is going to last. Of course, it will depend on how quickly and how severely your business has been impacted. So this is not one-size-fits-all advice, for sure. But employer contributions, whether they are safe harbor or not, are not legally required to be deposited into the plan trust until the due date of your company tax return, including extension. So we would be talking about sometime in 2021 at this point. So this buys you a lot of time and flexibility from a cash flow standpoint and keeps all the benefits of the safe harbor contribution provisions intact. Although many employers deposit match contributions and safe harbor contributions on a per pay basis, just as a matter of course, to make things simpler at the end of the year, there really is no requirement that you do that. And finally, note that if your document requires that you calculate match contributions on a per payroll basis, you'll need to continue with that practice with your payroll software because that's hard-coded into your document. If you're not sure if your match is calculated on a per pay basis or on an annual basis, review your document. Next slide, please. All right, so I just want to touch briefly, there may be some in the audience today that don't have a full-blown qualified 401k plan. They've got a simple IRA plan. This is really a popular plan design for many of our clients that are smaller. So it occurred to me as I was putting my slide deck together that I should spend just a little bit of time on this. Simple IRA plans cannot be amended or terminated mid-year to stop the company contribution requirement. And that's pretty blunt. At year end, you can choose to terminate the plan by giving notice to employees no later than November 1. And you do have the option, the same option I just talked about, of delaying deposits of company contributions, but obviously not employee contributions, same as the 401k plans. I encourage anyone that sponsors a simple IRA plan to also read your plan document. These are typically IRS prototype documents. They're usually on an IRS form. Too often, we're talking with clients that have simple IRA plans and they've lost track of their plan documents. So it'd be a good idea to see if you can put your hands on that. Finally, at the risk of stating the obvious, employees can request distributions from their IRA account in a simple IRA plan at any time. For those of you that don't have a simple IRA plan, simple IRA plans are funded using traditional IRA accounts. So the distribution, but if employees do pull money out of those IRA accounts, just like anybody pulling any money out of any IRA account, the distribution will be, and they're not 59.5, the distribution will be subject to the same 10% early distribution excise tax and federal and state income tax as a 401k plan. IRA accounts do not have the same rules as a 401k plan that require a distributable event before employees are able to request a distribution. So all that conversation that we had at the beginning of my my slides, that's really not an issue for you. Your employees can tap into those IRA accounts at any point without having to be inactive. Next slide. Plan expenses. So on the next two slides, I want to address your options related to any plan-related fees that are currently billed to your company. Typically, these are TPA fees and plan audit fees. I referenced those earlier. So assuming, obviously, that your plan is audited, any ongoing plan administration fees are allowed to be paid from plan assets. Typically, investment fund fees, investment advisor fees, plan record-keeping fees are all paid from plan assets. Whether you actually see those invoices or fees coming out of your plan or not, they're in there, I assure you. So if you'd like for your TPA and or plan audit fees to also be paid from plan assets, please discuss that with your TPA and your plan record keeper, and they will be happy to make those arrangements. Many of our clients already pay our TPA fee from plan assets, and it's a pretty simple, it's one or two forms that need to be filled out, and that can be taken care of. And then once we get beyond this current crisis, if you want the company to resume paying that TPA fee or the plan audit fee, you can certainly do that. It's not a permanent decision. Next slide, please. So finally, be aware that any plan-related expenses that pertain to the implementation, this is just a general warning. Any plan expenses that pertain to implementation, termination, or change in plan design are considered expenses of the company, not the plan itself. And so those expenses must be paid by the company. Typically, though, those fees are far and few between. But just be aware that if you're making any changes as a result of plan design that are benefiting the company and not the plan participants, those are likely going to be fees that need to be paid by the company, not the plan participants. And if you have any questions about that, you can certainly talk with your plan service providers. They'll help you with that decision. Next slide, please. So here's where we're talking about possible legislative changes, and this is changing hourly. But I think that the provisions within the CARES Act, it's going by a lot of different names, and I don't even remember what the acronym CARES stands for. But I think the changes that are impacting retirement plans are pretty locked in. So it appears these changes are pretty locked in. As I said, I lost my place here. So the CARES Act waives, with respect to hardship distributions, waives the 10% early withdrawal penalty tax on early withdrawals up to $100,000 from a retirement plan or an IRA for an individual who is diagnosed with COVID-19. And there's some criteria that you have to meet in order for the hardship to kick in. And so you have to be diagnosed with COVID-19, or your spouse or dependent, or you experience adverse financial consequences as a result of being quarantined, furloughed, laid off, having work hours reduced. I doubt there'll be a whole lot of attention paid to this. I think the assumption is going to be people are in financial hardship. So by and large, I think most Americans, they want to take a hardship, are going to be able to do that. They're going to meet the criteria. Next page, please. This is my last slide. But in addition, the CARES Act legislation also permits individuals to pay tax on the income from the distribution ratably over a 3-year period, and allows individuals to repay that amount tax-free back into the loan. And this is really a big paradigm shift. This is the first time ever that hardship distributions have been allowed to be paid back into the plan, similar to a loan. Those repayments would not be subject to the retirement plan contribution limits. They couldn't be. If they were, you'd never get them back in there. The Act also doubles the current retirement plan loan limits to the lesser of $100,000 or 100% of the participant's vested account balance in the plan. Right now, that's 50%. Individuals with an outstanding loan from their plan with a repayment due from the date of enactment, so that's going to be probably this week, through the end of this year, can delay their loan repayments for up to 1 year. And finally, the legislation permits retirement plans to adopt these rules immediately. So if your plan doesn't allow loans and doesn't allow hardship distributions, you can add that on the fly, so to speak, and then you'll just need to make sure that your plan is amended before the last day of the current plan year. And with that, I'm going to throw it back to Amani and kick off our Q&A segment of the program. Thank you.
Thank you, Paul and Doug. We're going to answer a few questions now from our attendees. So, does this 401k info pertain to the COVID-19 issues only? What if a company loses clients that would require a downsize in staff?
Is that who's that intended for?
I think that's probably more for you if there's a change in plan documents, I believe. Do some of those new laws.
Imani, can you reread the question? I'm sorry.
I can. So, Paul, does the 401k info pertain to the COVID-19 issues only? What if a company loses clients that would require a downsize in staff?
So, no, the rules that I just went through are not specific to COVID, except for the CARES Act changes that are probably coming down the pike. And those, I presume those changes will be temporary. We'll probably go back to the same hardship distribution rules. But all of the stuff prior to my discussion, the last two slides, the CARES Act, those are general rules that apply in any crisis. Good question.
Perfect. Paul, you also mentioned that our plan can pay the billed TPA fee. How do you start that process?
Like I said, it is best if you contact the TPA, and the TPA has a relationship with the record keeper. Typically, there needs to be authorization from the plan trustee, and that's what the paperwork is there to document. But your TPA can definitely facilitate that for you and get that turned into the record keeper, and then the record keeper, the mechanics of it, the record keeper would then pull the quarterly, monthly, whatever the fee, however you pay your TPA, maybe it's an annual fee, whatever it is, they'll pull that fee. It'll be ratably allocated across all participant accounts, depending on the size of their account balance. Contact your TPA; they can help. Thank you.
Great. And we also have one more question for you. If an employee is furloughed, are they able to take a full 401k distribution and roll it into an IRA?
They could. Yeah, they could. The key point there is, are they no longer being paid by the company? Are they eligible for unemployment? And if they are, they've met the definition of they've had a distributable event, quote unquote, for purposes of the 401k. They've got a number of different options. They don't have to pull the money out in cash. Some of my scenarios today talking about the tax impacts assumed that employees would be pulling those balances out of the plan in cash and receiving a check. And that's when they would be taxable. But obviously, yes, if you've got a large balance, and Doug might want to speak to this, but if you've got a large balance and you're terminated, then you don't need all the money to live on, obviously the prudent thing to do would be to roll it into an IRA and then just pull out what you need as you need it. Doug, do you have any comments on that?
No, that's good advice. Just because you need the money, you might not need it all, and you can roll that into an IRA and take the distributions from there to control your taxes and the 10% penalty.
Yeah, and if I can jump right back in, it just occurred to me, most of our plans are set up to allow just a single lump sum distribution. They're not set up to allow for periodic distributions. So most of you, check your document, but you may be required, if somebody requests a distribution, that you may be required to distribute the entire balance. So it's going to be important that they get good advice either from you or from your plan's investment advisor.
And then, Doug, here's a question for you. Should I change my future allocations to invest in safe investment?
No, I still say that you just need to stick the course. And, my previous comment that when I look at my personal 401k, one of my best investments happened in March of 2009, which was the low point of the market. If you're a young participant, or even if you're in your 50s, this money needs to last you a long period of time. Most of us are going to live into our 90s, and we want the market to be down. As we're dollar cost averaging in, we're buying shares much cheaper today than we were even a month ago, and that continues to go from there. So you're better off staying the course and continuing to invest. I've had some participants that even have gotten more aggressive with their contributions as the market's going down.
Great. And then, Paul, if my company has a safe harbor plan, can my TPA run an analysis for me to determine if it is cost effective for the business to continue with the safe harbor contribution versus paying to amend the plan and possibly needing to make the non-elective contribution if the plan is top heavy, as you indicated? Is this something Rea can perform if my TPA will not?
The answer is yes. But the best answer is, and the way we approach it at Rea is whether Rea is doing the tax advisory work or the tax planning work, plans are a fiction or a function of the Internal Revenue Code. They're governed by the Code Section 400 of the Internal Revenue Code. So these decisions regarding plan design are driven as much by employee benefits as they are by tax considerations. So it's always a good idea, and we would be happy to help. And certainly your existing TPA should be able to partner with your tax advisor to figure out and run an illustration. It's very easy to run illustrations with different assumptions, and you'll be able to figure out pretty quickly, I think, what is the best answer based on your specific circumstances. That's it.
Also, Doug, should we be looking to make changes to the fund lineup currently offered to employees?
No, we want to make sure that you stick with it. You can talk to your advisor, but that's why you have an investment policy statement and you do your fund monitoring. Even if you had some funds that were on the watch list, as the March data comes out and we do our monitoring reports for the next quarter, we'll make changes if we feel that it's prudent and if the funds are not currently doing what we want them to do. So at this point, there's no need to worry about that. Your advisor should be running those analysis next, probably over the next 6 weeks as the March 31st data comes out.
Okay. And the last question here, Paul, you mentioned ways that the plan sponsor can delay paying in company contributions. That does not apply to the employee salary deferrals, correct?
Correct. Yeah. You need to keep paying in employee contributions as quickly as possible. And there's no change in those rules. And it's really, really important that you continue to pay those in. And to the extent that you don't do that, you really create liability issues down the road. Those would be considered prohibited transactions if you don't remit employee contributions timely. So I know it's maybe tough with cash flow right now, but you really don't even consider not paying those salary deferrals into the plan timely.
Great. And do you guys have any last remarks that you guys would like to add before I conclude the presentation?
I appreciate you inviting me to be part of this.
All right. Thank you guys.
I was just going to say real quick, I would encourage anybody out there to get with their TPA or their investment advisor, whoever they work with on their 401k plan. If you've got any concerns, there's a lot of things we can do to help ease the cash flow burden of the plan on the company, especially during these really difficult times. That's it.
Awesome. Thank you guys so much. And thank you guys for joining us for today's webinar on what is life after coronavirus, coping with financial anxiety and recession. We hope that Paul and Doug were able to provide you with some valuable insight that will help you make sense of the current economic environment and how it's impacting your retirement plan. If you sign off today and realize that you have additional questions, you're always welcome to reach out to Paul or Doug directly. You can also contact any of our REA team members from the firm's website at www.reacpa.com, and that's REA. Don't forget to watch your inbox for an evaluation survey, access to the recording of today's webinar, and more. Thank you again, and we hope you have a wonderful rest of your day.